Good morning, everybody. It's nice to see you all again. So we have another great panel on decoding FDI trends. And in preparation for this, I was looking up at some statistics. There's been a broad decline in FDI since 2007 as a percentage of GDP from a high of 5.4% to 0.8%. There's been a decline since 2015 in absolute numbers of FDI. If you look at China, China's FDI flows are now about 40% lower than the peak in 2022. So what we're going to talk about today is what's driven those flows, but more importantly, what's going to happen looking ahead. What are the signposts that we need to keep an eye out for, and what can governments do about it? I have a fantastic panel, as always, and actually, I'm going to start with you, Molly, if I might. Molly comes from Standard Chartered, and you bring the perspective of a financial advisor. So say a little to us about how financial institutions are advising their clients to navigate this current climate.
Thank you very much for the question. So there's definitely a gap in financing, and the amount of projects that need to be done or that are slated to be done and the financing that's available, it doesn't match up. The numbers are quite huge. If you would look just in terms of digital centers, for example, 20 to 30 trillion, energy, 30 to 50 trillion, infrastructure projects, again, huge numbers. How do we bridge that gap? And there's really two different ways that I think. One is that if you look in the more developed markets, private credit is something that's been a subject on various panels here these last few days, and that continues to be a big part of the financing of these projects, and one that continues to grow. Over 50%, for example, if it's in Europe and Americas. So we really think that the private credit markets will continue to be key for these large infrastructure projects and will continue to grow across the globe. And then on the more emerging market side of it, one of the areas that's really helped is export credit financing, or these ECAs, which has been a risk mitigation. And this risk mitigation has caused those projects to be able to get done if there's the backing from the ECA agencies. So really two different angles based on developed or non-developed markets, but those are two areas that I think where we can provide, as a bank, connection between those two.
Fantastic. So you're seeing this massive gap between supply and demand, effectively, and growing gap. Rishi, let me come to you, representing Investcorp here. Say a word about the kind of emerging markets or sectors that you're seeing or that you're prioritizing in light of these flows.
Sure. So the lens we have, of course, is that of the investor, right? Mm-hmm. Because at the end of the day, we are deploying capital based on A, where we see a good risk-return opportunity, and B, where investors are aligned with our own thinking, and they see the same attractive opportunity and want to put capital behind that. Now, in terms of stock, right, there is no doubt that the United States continues to get a significant level of interest in terms of private investor capital, particularly in private markets, including private credit, but also other private asset classes like PE, infrastructure, real assets, et cetera. But the pivot that we are seeing, particularly over the course of, I would say, the last couple of years, is around the Middle East, the GCC in particular. The GCC historically had been seen as a source of FDI, of investor capital, getting deployed predominantly in the developed Western markets. To some extent, a build-up recently into Asia as well, but still was predominantly a source of FDI. Over the last few years, we've seen increasing acknowledgement and recognition, and actually embracing by the investor community of the fact that the GCC offers as attractive a destination for FDI as it was previously a source. And that, in turn, is mobilized by the fact that all of the local GCC leadership, governments, et cetera, are very keen on implementing a long-term vision that is all about economic diversification, but equally about private sector participation in that economic diversification and development of their respective local markets. And that private sector participation brings financial discipline, rigor, and a validation, if you will, of all of those visions. Now, ultimately, the proof of the pudding lies in what has actually transpired. And the best illustration is very recently, we had one of the largest sovereign wealth funds in the world outside of the region from China, very specifically, CIC anchor a fund managed by Investcorp that is specifically targeting deployment of capital in the region. Right? That is a first, and the mere fact that whole turnaround has been manifested and is being implemented now tells you how the flows of capital, at least in investor minds, are changing.
So Rishi, I really want to pick up, and I'll come back to you on this. This idea of China investing in the Middle East, and more broadly, we talk about globalization or regionalization. I'd love to know whether you're seeing that play out in this space as well. But Jerry, I want to come to you first. How are you doing it? So you're here, representing PIF. How are you getting that kind of interest from the Chinese, from others, into the Middle East that Rishi just spoke about?
Thank you, Zaina. Pleasure to be here. I think governments have to compete. They have to understand why the global manufacturing footprint is at play, and what steps they can take to position themselves to attract that business activity, which is why FDI comes in the first place into your country. And so, we've had 3 generations of efficiency-seeking FDI, where's the lowest cost place to manufacture. And we're entering into an era where people are still obviously very focused on cost, but they're also focused on risk reduction. And how do you reduce uncertainty? How do you increase the predictability of your supply chains? And so in that world, where predictability matters, where uncertainty is something you're trying to reduce, where the impact of tail events is something you're trying to reduce, and in a world where there's been a lot of trade action. So in the past 13 years, the number of trade actions that have happened globally has gone up almost 11x. You find people looking for places that have political neutrality, that have long-term access to green energy, that are closer to markets, so that you reduce the length of supply chains and therefore the number of things that can go wrong. And this is driving a change in trading behavior. So if you look at trade between politically close nations, it's up 6 points in the past 7 years. And between politically distant nations, it's down by 5 points. And so that is ultimately driving the shape and form of FDI. And so at the country level, looking at that landscape, you need to figure out how you become an attractive place to locate. So trade is becoming very important in terms of trade relations between countries, providing access to long-term sources of clean energy, having business-friendly policies, all these things, plus incentives and others, all these things that in some way or another help global business reduce uncertainty around supply chains, ultimately is how you compete.
I'm going to come, Rishi, to ask you to answer that question, but I want to come to you first, Molly. Jerry brought this idea of risk, and you kind of almost a broader contextual risk at the moment, and what is it that governments can do to lower that risk? How do you see risk changing from your vantage point? What are your clients saying? What are your investors saying? What is it that you see?
So I think investors and our clients want to have some degree of certainty, but they're used to operating in very complex markets, and also there's always something happening in the world, so you have to be able to react quickly to that. I think they're looking to invest where they understand, and they know that there's a enforcement, that there's a rule of law, that there's a strong capital markets. Those are the main things. We do see, of course, being global cross-border bank and being a very super connected bank in 52 countries without really a strong individual home market, that we are well situated to understand when those trade flows are changing. And certainly, if you look at one of our largest markets, which is Asia, you did see and have seen, and we're currently continue to see, a shift where there's much more intra-Asia, for example, flow, which we're experiencing, rather than perhaps going to the US, as you might have seen previously, although there is still an element of that. So I think you need to be responsive. I think you need to see, understand where the flows are going, what's changing, and be able to react. And that's what we really see our clients doing across the globe in a variety of different markets. And certainly the interest in the GCC is continuing to grow, and that real connection, particularly between our US and European investors into GCC, as well as our Asia-based clients.
So are you seeing, picking up that point, Rishi, that you mentioned earlier of kind of Chinese investment into the GCC, are you seeing more and more of that? I mean, one of the panels that I was on yesterday, we were talking about that there's a common, not so much culture, but understanding emerging market to emerging market that perhaps you don't see from advanced market into emerging market in quite the same way. Is that becoming more common, do you think, for any of you?
It's certainly gaining momentum, no doubt about it, right? Look, we've been investing in the GCC ourselves since 2007, right? So it's coming up to almost 20 years now. Jerry will remember this. But much of the initial capital that we were deploying into the region was really sourced from the region. Right? So it was from the region for the region. What we've seen evolve, particularly over the course of the last few years, as I was saying earlier, is a clear recognition within the broader investor community globally that there are certain facets to the GCC economies that whilst they have the characteristics of an emerging market in terms of a very attractive demographic, relatively young population, digitally native, high propensity to consume, high disposable incomes, etc., and high growth rates, there is one or two other secret superpowers almost of the regional economies that make them look more like developed economies in terms of lowering the risk. One of which is the fact that the currencies are pegged to the US dollar, right? So the currency risk, which many of us have to underwrite in all of the other emerging markets, becomes a non-issue for the region, right? The other is that the stability of policy led by the leadership in the region is something that you can rely on now, right? So those two or three considerations taken together have really resulted in this significant uptick of interest amongst the international investor community, both institutions as well as private wealth now, saying, actually, you can get the same returns as you would target from an emerging market, but with lower risk, right? And therefore, it is an attractive investment opportunity. And the underlying growth characteristics of the respective economies are such that there are certain sectors that present a very, attractive risk reward, like I said earlier, including, for example, and to pick up on Jerry's point, logistics and transportation. There's a clear desire, energy transition, there's a clear desire to stake out a claim of, real genuine claim of leadership in that space, and healthcare and certain other spaces.
So I want to flip us to look forward for a second, because we've kind of talked about the current status quo and how we've got here from where we were. We've only got about 5 minutes. Flip forward, if you would, all of you, and what do you see changing? What do you see over the next 2 to 5 years? We haven't talked about technology. Are there particular sectors that you see might be growing or declining, particularly geographies? I'd love to hear, I think the audience would love to hear, where's this going?
I mean, I'll jump in a bit that follows through somewhat on some points that Jerry made as well, but really where we're seeing a lot of interest is people want to be, if we're looking at GCC in particular, they want to be in the region. And so we're seeing more of our clients set up here, there. The other piece that I think continues is the need for data centers, transportation, infrastructure, renewables. All of these are equally important and I think very key across the globe.
So kind of infrastructure, but also localization almost.
Yes.
The idea you have to be in the region to deliver to the region. How about you two? What do you see?
So I think the world needs less buyers and more builders.
Less buyers and more...
Less buyers and more builders. And if you look at where building needs to happen, there's obviously in the technology space a lot of infrastructure required for that. But to deliver prosperity in any economy, things need to be built. And so, in the way financial capital, excuse me, gets into a building mode is either through corporates, through operating businesses that expand, or through financial institutions that are set up to actually deploy capital on a primary basis. So smart strategic capital. And so the thing that the opportunity that I'm most excited about, and I'm talking my own book here, is the building opportunity in Saudi. It's historically been a market with lots of capital-light business models. And we are now seeing a CapEx drive to industrialize the economy and build out the service economy at scale, which requires built environments to serve those needs. And Jerry, number one, was up here just a few minutes ago talking about the Diriyah opportunity. But that is happening across the kingdom and across different kind of sectors, serving the needs of different constituents. So it is a generational opportunity that I hope everyone takes the time to understand.
Building.
I think what I would add to that is, look, again, we see the emergence of the GCC region as an attractive destination for future investment, no doubt about it. There are certain sectors in particular, building along thematic lines that were articulated by Jerry earlier, that stand out. I think business services, just given the explosion that we are seeing and will continue to see of small and medium-sized businesses that are cropping up in that part of the world, all needing business services support, IT services support, et cetera. So business services, broadly speaking, is an area that we think will grow quite exponentially from an investment perspective. Broadly, beyond that, I think the transportation, logistics, and digital infrastructure space offers a very attractive opportunity, whether it's to build or to build and expand. It's all about growth at the end of the day. There is no better driver of long-term return than underlying economic growth, right? So, betting behind some of those long-term secular trends, whether in the region or globally, is really what we think investors are seeking. And they recognize that, there is a certain risk and a return that they can expect out of investing in developed markets like the US, which, by the way, continue to be a dominant recipient of that investment capital. But there are other markets like the GCC, like India, and other pockets in Asia in particular that offer equally compelling risk-reward.
And I think people don't want to miss out on these opportunities. You don't want to be 100% invested in one economy. You want a diversification. You don't want to miss a very large growth cycle. And that's the role that we play, where we bring clients across the globe into various markets and economies.
So we started this conversation, as we come to a close, we started this talking about actually the decline in FDI over the last, say, decade or so, either in absolute terms or in relative terms as a percentage of GDP. Headwinds, tailwinds. Are you feeling optimistic or pessimistic?
I'm
looking ahead.
Optimistic.
You're feeling optimistic?
Sure. Yes.
I'm selective. So I think there are tailwinds for the US, tailwinds for the region in the Middle East, tailwinds for markets like India, a little bit more challenging and a micro assessment for specific opportunities in Europe.
Okay.
And then the rest of the world we are not experts on.
Okay.
I think you don't know, and you can't predict, so you have to tack.
Okay, tacking. Thank you. Will you all join me in thanking our panelists for this conversation? Wonderful.
Thank you.